Good morning, everyone. My name is Bella. I am the office manager here at KWB Wealth, and I will be your host for today's 2024 Economic Outlook. Before I hand it over to our presenters here, got a few announcements for you. This webinar is being recorded and will be made available to you on our website under the Resources tab, and it will be posted to our YouTube channel as well. There are 2 poll questions that have been launched. You can hit the polls button below. Take a moment, answer those questions, and we'll go over your answers at the end of the webinar and just see how you're feeling about 2024 so far. Also, at the end of the webinar, we'll be doing a Q&A session, so feel free to type your questions into the Q&A box below. It should be near the bottom of your screen there. And at the end of the presentation, we'll get to as many questions as we have time for. So today we have the Bubs joining us. We have Carrie, Quentin, and Rachel Bub. So Carrie, will you take a moment and introduce yourself? And we do have a question for us here. When you were younger, what did you think you wanted to be when you grew up?
Good morning, everybody, and thanks for joining in today. My name is Carrie Bubb, and I'm the founder and president of KWB Wealth, and I'm joined here with my son and my daughter. So it's a Bub extravaganza, and we like to mix this up. So if you tuned in last time, I think it was Mike and Quentin and Bob and Diana. So you'll see different people on these economic outlooks as we go forward. But hey, first off, when I was a kid, I hope I would never grow up. Life was pretty good. But if I did have to grow up, then at the time, there was a guy named Lee Iacocca that was inventor, I guess, the main guy behind the Mustang, the Ford Mustang. And he also was involved with rebuilding the Statue of Liberty. And I always thought I wanted to be a corporate person. You know, he had an engineering degree and a marketing degree and sales. And that's kind of what I thought I would be. But anyway, here I am, and life is good.
You're still in corporate, small corporate.
Right.
And you definitely climbed that ladder. So my name is Quentin. I am an advisor here at KWB and the chief operating officer. When I was a kid, I don't remember telling my 5th grade teacher this, but my mom says I did, so it must be true that I told my 5th grade teacher I wanted to be a financier like my dad.
Right. That word doesn't exist, but we got
the point.
5th graders are allowed to make things up. So.
Yeah. Hi, everybody. I'm Rachel Bubb. I'm an advisor here. And growing up, one time I remember thinking I wanted to be a lawyer. And I remember my dad saying I should be a lawyer because I liked to debate. And argue, excuse me. And but then I also really loved biology in high school. So I had a really great biology teacher. And I remember going into college and wanting to do something, whether it was climate studies or working on a farm, which I did. And now I've grown up and here I am working as a financier. Yes. So everybody, thank you so much for joining us today for the Economic Outlook. We're going to be talking about what we predict for 2024 or some of the things that we're seeing. And we've got some other topics. But first, to present us, I want to do a little reflection back and talk about 2023 and just recap where we came from. Because 2023, we started in January, because everybody likes to forecast what's going to happen for the following year. Everybody was predicting a recession. That was the main forecast, and it was pretty general consensus that a recession was likely. Then in March, we had 3 bank failures. So first it was Silicon and Signature Bank, and then First Republic ended up failing in May of 2023. July, we had the final FOMC rate hike, and we ended up at 5.5% in 2023 for federal funds rate. And then in October, Hamas attacks the Gaza Strip, starting another war across the globe and in the Middle East. And then October 29th, the market bottoms. And after that, we end up with a 9-week rally for the S&P 500. And the S&P 500 ends up positive 24% for the year 2023. So we start with
7 great companies for the most part.
Yeah, right. 7, the Magnificent 7, which I'm sure a lot of you have all heard about as well, because that has been pretty broadly, widely talked about. But yeah, we started with a forecast of a recession, and then here we end up with a strong ending of the year with 24%. And then we start 2024, and we have a market, small retraction.
We reached all-time gains just a few days ago when we're still flirting with it. Yeah, so when I look back, it's like 20 2022, we go back to consensus. In 2022, the consensus was, and this is January, the Fed would raise rates a quarter of a point and the market would have a pretty good year. How wrong was consensus, right? They actually raised rates 11 times over a year and a half, but the markets were terrible in 2022. And like you said, Rachel, 2023, everybody predicted a recession. Obviously, we didn't have that. So I don't know. Being in the consensus makes me a little bit nervous. As I look at 2024, I think there is a consensus, but it's maybe not as strong. And I think the consensus is we're likely to have a soft landing. We're likely to see no more rate increases, and we're likely to see the Federal Reserve lower rates, a few times from here. But I don't think that consensus is as strong, which gives me a little bit of optimism, because usually the consensus isn't right?
Yeah, and some of the things that we've seen that are working towards a positive consensus is that the labor market, the last report in December was a positive labor market report.
Right.
And then, or jobs report. And then we're starting to see a little bit of a loosening, which is okay. It's not a significant increase in unemployment or jobless claims. And then we have also seen inflation is starting to come down. So consumer goods pricing hasn't increased. I think services pricing is a little bit higher still. And ultimately, the Fed's goal is to get to that 2% inflation, and we're still hovering around 3%.
So Bella, if you show us the slide number 3, kind of just shows pictorially how aggressive interest rates rose from 21 to 23. And then now you'll see in the dotted lines kind of what the markets are expecting and maybe what the FOMC is actually projecting. So we always have a little disconnect between what the markets hope for and maybe what the FOMC predicts. But, the economy was really, really good, and the Fed wanted to slow it down. And I think the good news is maybe they did it. Yeah. And they did it without wrecking the economy, at least to this point so far. Right. Yeah. So a lot to be positive for as far as that. Again, it appears that the Fed has finished raising interest rates, and that's good news. They always say two things. One is don't fight the Fed. And so what that means is as the Fed was raising rates in 21 and 22, they're trying to slow the economy down. That's probably negatively going to impact the markets. Well, they were right, because as the Fed did raise rates, the market really had a troubled time in 2022. Mm-hmm. The markets kind of believed the Fed was near done in 2023, and that's why I think you saw the market rally. But as we go to the next slide, and Quentin, you can talk about that, is why should we be optimistic maybe about stocks and treasuries going into 2024?
Yeah. Well, I think that, we as a people in our country, whatnot, we're pretty resilient. If you look at where we've been since the pandemic and now where we're at with higher interest rates and looking forward where we're going to go next. So, this shows the chart on the left, or the little chart on the left there with the S&P 500 return shows 1, 2, 3, 4, 5, 6 times when the Fed has gone from no longer raising interest rates to now we're going to start lowering interest rates. And it shows the market return for the S&P 500 2 years later. All but one of the times the market's been positive. And the one time that it wasn't positive, we had the tech bubble. And if you remember, that's when we were trading on E-Trade, flying around in our helicopters, buying islands, doing the pets.com and all of that. I don't remember it much, but I do remember some of the commercials. And then right after that happened, we had the Trade Center attack, the World Trade Centers in 2000. So that has those two things stacked on top of each other were, an event that was maybe abnormal, that caused the S&P maybe to not be in the positive return area that it was the other times.
So the odds are pretty good that historically, once the Fed is finished raising rates and likely beginning maybe even a decreasing, it appears to be statistically positive for us.
For stocks and bonds. Because on the right there, that's 10-year returns after Fed cycling or hiking cycle stops. Again, all of those are positive as well.
Right. And what I also love about this chart is it does end positive, but the road to get to positive isn't a smooth one. So you can see a lot of ups and downs, especially in 2015 and 20 through 2018. The market isn't going to have a smooth ride. It will end positive likely, or at least that's what this history is showing us. But we do need to be prepared for market pullbacks like we've talked about with all of our clients, that on average, the S&P 500 experiences a 15% pullback a year. The only year that, or the anomaly in the most recent time frame, was 2021, where I think
Just went straight
it
up.
just went straight up. And that's not normal. It felt really good. And then we paid for it in 2022, where the 60-40 portfolio was down, like one of the third worst performing years for a 60-40. So you stick to the plan and just know that as you cover your eyes a little bit and try to hold on, it will be rewarding for you.
Yeah, and it goes back to don't fight the Fed. If the Fed is easing, that's typically good for bonds, because as interest rates fall, bond prices go up. As interest rates fall, that means investors are forced to take other risk. That means maybe the market goes up because of multiple expansions. If interest rates fall, mortgages get cheaper. I mean, there's a lot of positive things in that. But I think the other thing people have to also take into account is a lot of people have been, and we've been encouraging it, with taking some of the cash that had been sitting in banks, earning nothing almost for 13 years, until the last 2 years. Finally, you could buy CDs or money markets or treasury bills and actually earn a return on your cash. So I think you also have to be careful about getting too complacent or comfort. So Bella, if we could go to the next slide. What this shows is that sometimes keeping your money in the safe thing at 5%, you think that's really good and prudent. But what it shows is, what did you miss out? Had you put the money maybe just in the S&P 500, companies, Costco, Home Depot, and whatnot. And what this shows is that on average, after 1 year, your return, you missed out on 8%. Over 2 years, it was 17. Over 5 years, it's 54%. And so part of the reason is because as your money matures, you're forced then to reinvest that money at maybe 4.5, and then maybe 4, or maybe 3.5, or something like that. So if your horizon is, at all, 3, 4, 5 years out there, don't get too complacent thinking, oh, this is great, put it in treasuries, and ignore some of these other opportunities out there.
Yeah, you want the right money in the right buckets. So if you are, longer term, you've got time till retirement, or something like that, you don't want to be putting all of your nest egg in cash or in treasuries. But if you've got that, hey, I need to buy a new car in 6 months or 2 years, like that's the time when you want to use those more conservative guaranteed buckets versus maybe using, going into stocks and bonds.
Well, and so with some of the clients that I've been working with, we bought a T-bill, it matured in 6 months. Oh, what should we do again? Oh, let's put it another one for a year. And then I recognize, like, okay, well, this isn't necessarily a shorter term asset that we're talking about. You don't actually have an intention of using the funds, but we like the return, which is, yes, I agree, it's been a good return. And when we're thinking longer term, then we come into something called reinvestment risk, which is something that we've been talking a lot about here, where as interest rates go down, bond prices will go up. And then when you're wanting to reinvest your money because the T-bill matured, you're either going in at a higher price because the market has moved up, usually as interest rates go down, right? That provides a little stimulus to the economy. So that's where, great, going back to, you have to make sure, where we encourage, let's make sure that the money that is sitting there is intended for short-term use. And if it's not, we need to thinking a little bit longer term, at least at this point, knowing that the Fed is going to be doing 3 to 4 interest rate decreases this year.
Likely, right?
Likely. Who knows, right?
Right,
Who knows?
right.
Don't ever say it for sure.
And as you look at the U.S. market, certainly the U.S. market has a phenomenal run. The markets aren't cheap. We're predicting, or consensus is predicting, soft landing. There's a lot of positive things out there, and for me, in the last couple of years, it's been hard to imagine that we would have a recession when anybody that really wanted to work could work. And in America, if you're working and you have a job and you have a paycheck, what tends to happen is we spend the money. We go to Disneyland, we go to Costco, we add on to our house, we do whatever we want to do. And the US consumer drives 75% of the economy. I think as we go forward, we also have to think out of the box, because I don't know if the US will always be the king. So one of the things that we look at is it goes back to diversification. And sometimes people forget about that things do rotate. As far as last year was about the Magnificent Seven. A couple of years ago, it was about value. Before that, it was about international. So Bella, why don't you pull up slide number 6?
Yes, we've been getting a lot of questions, and I even hear this from younger investors. Why not just put all my money in the S&P 500? Especially for younger investors who are like, I've got so much time, right? I'm looking 30, 40 years now. Let's just put it all in there. That's where all the returns have been over the past decade. And for me, it's still, I still believe in diversification because there's a behavior component to it where it could be all talk, but at some point, maybe talk is cheap, because if you're seeing the US market have 10, 15, 20% pullback, or even what it did in COVID, could you withstand that? Would you have stayed in, or would you have made a move? Because that is the worst time to pull out of the market.
Yeah, the next 10 years might not always be like the last 10. And, yesterday our director of portfolio management Steve was showing us a chart where we were looking back at like what happened 2009 and prior. And it's like, that was very, different than what happened the next 10 years. So, it's not always, matching up with what happened before. And this chart here shows us in the purple, the, international, and then in the gray, US. So during those time frames marked on the bottom, going back to 71, what outperformed. And you can see, back in 71 through close to 74 there, we had 2.5 years where the, EFI outperformed the US by 80%. And then in, the 83-ish, for 5.6 years, it outperformed 300%. In 95, for 6.2 years, the US outperformed by 220%. And then going back now, the last 10-ish years 14. Or 14 years, the US has outperformed 277%. Now, what's interesting about what's happening now, though, as we look forward, is like, hey, interest rates potentially going down. And usually that means that the dollar might weaken, which is then beneficial for internationals and emerging markets because it's cheaper for them now.
And certainly on a valuation standpoint, the international stocks are cheaper than the US. Mm-hmm. But I've been saying that for years. We have a strategy called Contrarian, and I still believe in it. And I think it's going to work, but I keep wondering when it's going to work. And so then you do have to stick to what you've done, because the wrong thing to do is, give up, go to the other line, just like in a grocery store, and then you're always better off to stay put. Yeah, cool. So international should still be a portion of your portfolio, and don't get mesmerized by the US and the Magnificent Seven, because back in the day, there was the Nifty 50. And there were companies like GE that just buy GE, and we've seen what's happened there.
Yeah, so you just don't know what's really going to stay in there and for how long. Things will change. Reversion to the mean is also something we talk about.
Well, and when we're working with you and the clients, like, it's about maximizing your portfolio, like, not your portfolio, but your financial plan, not really, and optimizing that, not really maximizing every dollar out of the portfolio and, wringing it for everything we can get from it. It's more about, hey, what are your goals, your long-term vision? What kind of legacy do you want to leave behind? And planning for that. And, oftentimes that means we need to diversify and not just put it all in one spot.
And only with hindsight do we know how to optimize. Someone, we were on a call the other day with a client. Well, do you ever in October, like when the market was down, tell us that's a good time to invest? And it's like, well, it wasn't until November, December that I knew that October was the right time to invest. Right. So it's really, looking back, hindsight is really clear. And yeah,
I remember in October too, a lot of investment bankers, economists, all the forecasters were lowering what they thought the S&P 500 would end at. So then they were also reducing what they thought, and not knowing that we'd have a 9-week rally.
Right. Yeah. So as we look forward, some of the other things that they say, so goes housing, so goes the economy. And what they mean by that is if the housing market is strong, typically the economy is strong. And one of the things that we see today is the housing market is pretty strong. A lot of the consensus was as interest rates rise, housing would come under pressure. And frankly, we haven't seen that at all.
No, housing in the residential, single family homes, there's been tons of pressure still because, 50% of the home buyers in 2023 were all first time home buyers, which means for every home that person, that 50% took off the market, they weren't adding a home behind them. They were just pulling them up. So
using existing inventory.
Yeah,
right.
using the used homes,
right?
As Carrie will call them. So what was happening is like if there's 24 homes for sale in your neighborhood or your community, and there's 50% of that's being bought up, that means now there's 12 left. And there's not an added addition to that. So that's been part of the pressure. The other thing is, new home builders have been discouraged to keep building, and they have been since 2008. They picked up a little bit there for a while, but now they've slowed down a little bit. They're still probably really the only game in town, depending on where you're looking. But it still looks pretty good for them. Now, as interest rates go down, that is where we're going to get into this area where like housing prices probably going to go up. Maybe they're not going to like all of a sudden like skyrocket to the moon, but housing prices will likely go up because now the affordability in theory got better. And then at some point, maybe it flattens out for a little bit once we kind of stabilize. But right now there's a 3.5 month supply of homes. And I think the stable market is around 6 months supply.
Hard to imagine housing going wrong here. Right now, currently we have two, younger people that want to buy their first home, and they've kind of challenged. The markets are crazy high, interest rates are high, and it's really getting more difficult for that new person to get in the market. And unfortunately, I don't know that's going to get any better. So if you do have a house, great for you. It's a great time.
Yeah, it's a great time to sell.
Right. And
but if you have to go rebuy, it's not a great time. They're saying that 2/3 of the mortgages outstanding have a interest rate lower than 4%. Right. So why would you leave?
Right. And I think really what it's all about is you look at your balance sheet, your home is worth more, you feel better. That goes to, you spend more and all the other stuff. So that's why so goes housing, so goes the economy. But there is one part of the economy, or I should say real estate, that is probably a little more problematic that I see on the radar screen, which is more to do with the commercial office space and industrial space and maybe even retail space. So let's go to chart number 7 and talk a little bit about that. Just real quick, and then I'll let Quentin take over on the chart. But, Rachel mentioned that in March and May, there was those 3 bank failures. Those bank failures weren't caused because of any real estate. It was caused because those guys didn't match up their liabilities, with their investments. And they bought really long-term treasuries, right? But going forward, as you look in the commercial market and the office market, there could be some things that we might want to be attuned to.
Yeah, if you look at the chart there, on the left, it's the large banks. So it's like your JP Morgan Chase. And then on the right is your small regional banks, like the ones, that did collapse back in March. And you can see there that they have a larger percentage of their balance sheets tied to commercial real estate versus the larger banks. So, I remember back in March and April getting a lot of questions. Well, should I be concerned about Chase or, Wells Fargo or wherever it was? And it's, probably not. Like they're managing more. They've got, daily users, us as consumers going in and out with our cash. We're not, lining up, and they weren't specializing in certain areas. Some of those small banks were specializing in areas and they thought, this is great. Money keeps coming in. Let's just buy a bunch of long-term treasuries. So if we had a slowdown and we stopped spending money on new purchases of, whatever it is we're getting in our daily Amazon delivery, that could impact the commercial real estate there. And then those guys, are not getting their rent. And that could ultimately, roll down to these banks. The other thing that's going to happen is, commercial real estate has a shorter time frame on their loans. When we go get a home loan, it's 30 years. Commercial property is 10 years roughly.
Or 5. Short-term refinancing.
Yeah. So they got to refinance now the next couple of years here to the higher rates, and that'll crush their margins a little. That'll impact their margins with the rent. They may have to go increase rent. but it'll be difficult to do if the businesses aren't having they're not going to, hey, I'm going to leave, I'm going to go somewhere else.
We're already starting to see some of that, like in San Francisco, the big mall with the Nordstroms, they just gave it back. Here in 2023, a building was recently sold and it sold for 200 million.
Yeah.
But in 2014, it was purchased for 400 million. So between 2014 and 2023, that office high rise, I think it was the AON building or something, went from $300 a square foot to $150 a square foot, where, the vacancies, work from home, the inner cities aren't as popular. So the big thing there is not to scare you, but it's like, the subprime market really impacted the financial crisis because of what happened there. I don't think that is this personally, but it also could turn out to be a little bit more of a problem, but not enough to really wreck the economy, in my opinion. But there might be some opportunities out there in the coming years if you're a commercial investor and want to buy tilt-ups. Maybe wait a little bit before you go do it.
Office space is the other one that's getting impacted, but probably not as significantly. It's just more of a downsizing effect. And then what you might see is they take a larger building, they split it in two and try and do something along those lines.
And I think that's regional because, we're in Redlands and they haven't built any office space except for one new building here in 20 some odd years.
Yeah.
In LA or San Francisco or Seattle or Portland, different story.
But you're losing space too. Like, how do you keep building LA?
Right. Yeah. So today's Tuesday, and I think something's going on in New Hampshire, right?
Yeah.
I think.
Right.
And it's about politics. So one of the other things that we want to kind of just talk up and then take your questions is, as you know, this is a pre-election or election year. And sometimes people say, well, what happens if this guy gets elected? What happens if that guy gets elected or that girl or whatever? So let's go to slide number 8. And who wants to talk about the election? Rachel?
Yeah, we won't spend much time on it because we'll leave that for our friends in the mid-year economic outlook because let them make the prediction. It'll be closer to the time. It's just so far out. I mean, we look back again when we were forecasting in 2023 a recession. How much can change by the time you get to November or December. But when we look forward, at least for how the markets can do and the economy, this chart shows us that election years, they tend to be weak early and rally later. So January, February, March, you can see this first quarter could be pretty flat and probably some volatility. Maybe we go into the negative. This is showing us back all the way to 1950, the average year for the S&P 500. Really where we see a lot more opportunity and growth is towards the end of the year when we have more clarity about who's elected, because the markets like certainty. So when we know that so-and-so is going to be in office, we have a little bit more of an idea of what will happen fiscally and some of their policies. And then companies can start to adjust to that and make decisions for the next couple of years. Really, probably where we see more of a negative market impact is the year following the election or the year 2 of their term. And it's because some of the things that they've made decisions around are starting to take place. Right now, no one's talking about a fiscal deficit. But
the 30 trillion we owe?
Yeah. I mean, I haven't heard anything about it, but but last year we heard a lot about it. In 2022, we heard a lot about it. So in election years, politicians don't want to talk about controversial topics because it doesn't look good for their campaigns. So I would say expect in the next, couple months, it's going to be a little bit bumpy. And we just came off of a 9-week rally, but optimistic for the ending of the year. And on average, an annual return for a 60-40 portfolio during election years is about 8.7%. For non-presidential election years, it's 7.7%. So
we should be happy that it's an election.
We should be. And a leap year, we get one extra day. The leap year babies get to celebrate their birthday. There's a lot of good things going on this year. So I would say US-wise, it's our election it's going to be a controversial one. It's going to be a dividing one. There's probably going to be a lot of negative news and press around it. But Americans tend to be resilient, hopefully. I think some of the other things going on globally are of concern. And you look at, there's more than half of the world population in the world will be voting in elections this year.
It's a big year for, potential changes in government. for the whole world.
Yeah. And so how will that impact? We're seeing impact in the trading routes in the Middle East with the Red Sea, and there's a lot of piracy, and trading companies can't get insurance. Insurance costs are going up. So there are things like that could impact, and that will probably impact Europe more so because they rely on that canal for the trading route, and that could lead to an increase in some of the cost of goods, and that we'll have to see how that plays out.
Yeah, and for me, it's always look at what people do, not what they say. A lot of times we'll ask people like, well, how do you feel? Well, I'm doing pretty good. I'm worried about my mother.
Yeah.
Or then we ask the mother, well, I'm doing pretty good. I'm worried about my kids.
Yeah, I'm worried about you.
Yeah. So, fear sells. And somehow, mankind, we wake up, we dust ourselves off, we go to work, we come home, we live our life. We want to see our grandkids grow up. And so I think optimism and hope has generally been a better thing to, I guess, absorb because it's been better for your portfolio. There has been a lot more money lost fearing things that never happened than, the things that have happened.
Yeah.
So with that,
I'm not saying be naive about what's going
absolutely.
on. I mean, definitely there are some concerns, but it's focusing on what you can control and recognizing that companies are resilient, people are resilient. That's what I think stands out most to me is I look at like even with Apple and what they were experiencing with the Apple Watch, they learn how to move forward. There are a lot of intelligent people that work at Apple that are working on how to figure it out. We really focus on our financial plans here because at the end of the day, if we can, and we're using conservative growth rates in those plans, understanding and knowing that we're going to experience years of extreme volatility, like 2022 to 2023, we put that into the plan so that we can help you guys have some comfort. We feel comfortable about you accomplishing your goals. And that's why even going back to what Quentin said about investment strategies, why take unnecessary risk if what we're doing is working to get to your goals? And we focus, I've just seen that a lot of behavior comes into play, and it could look really good and you're loving the returns in those years, but it's really hard to stomach some of that, the volatility in the down years. And so that's why we always go back to the plan to try to provide reassurance because we feel confident in that.
So we've got a couple questions here I brought up, and then I guess we'll let you go ahead and answer the poll question if you haven't, and then we'll get to that. So the first one here is, do you think a 60-40 split is still good moving forward?
Yes and no. If you are 25 years of age and you have a long time, you probably ought to be 100% in equities with your retirement funds. If you're, closer to using your money and you need it and you don't like volatility as much, 60-40 is more appropriate. I'm an older guy, I'm 62, I'm probably 90-10, as far as stocks to bonds. So it kind of depends on your time frame, what volatility you can anticipate. But I would say the good news about a 60-40 in 2024 is that both areas of the portfolio ought to be okay. If the rates go down, the 40% in bonds is going to do well. If the rates go down, will the stocks do better than the bonds? We don't know. But I think 60-40 is very prudent, and it could either be more or less depending on time frame and the kind of money you have.
All right. So the other question we have here is about AI. So is KWB utilizing AI, and what is your opinion of AI with regards to investing? So at the firm, we do use AI. We have been. It's a technology that has allowed us, I think we have 15 employees and 16 employees, and probably not that many more than you had back in 2000 and 2005. So it's allowed us to do more with fewer bodies in the building. Some of that's just been related to the other advancements, but we use it within our CRM, which is where we keep track of all the stuff that we're doing for our clients. So we are using it there. As far as the investment side of things, it's AI is not really forward looking at this point.
It's definitely in your portfolios, right? If you own the S&P 500, you have exposure to AI.
NVIDIA,
Yeah,
Facebook,
Meta. These three companies are projected to put a significant amount of their capital expenditures into AI research and development this coming year and the next, where you probably will start to see some of the investment returns of their research and development into it is 2 to 5 years out from it, right? It's not going to be an immediate implementation and then, wow, the company has been able to cut their workforce and productivity has skyrocketed. It's going to take time because there's also a lot of challenges with AI and the regulatory environment and making sure that it's complicit and there's not biases that come out of it. So we talk a lot about investing in it. Do we invest in the companies that are producing it or the ones that are using it?
Who benefits more, the company implementing it or the company that manufactures it?
Yeah, manufacturing the chips for it. So you also have to be careful that companies might be saying, hey, we're investing in AI and using AI, but it's really more of a selling point to get you to invest in their company. So there's going to have to be some screening, and that's where probably some sort of active manager could really help choose out what are the companies that are going to benefit from it.
Well, that's why we own too in your portfolio, again, not just the S&P 500, we own small and mid-sized, growth companies, because that's where those guys are. That's where like Apple started. That's where NVIDIA started. That's where they went. And then they became the S&P 500. And likelihood is that, some of these smaller companies that are doing these great things and investing and building this technology, they're going to get bought up by the Apples, the Googles, the Microsofts, and then you'll participate in that by having some of the exposure both in the small, mid-sized companies and large S&P 500.
Great. All right. The next question is Project 2025 plans to gut the federal government in a Republican administration. 50,000 unemployed. Impact on the market? So there's a couple of statistics I don't know. I don't know exactly how many people the government does employ. I would imagine there's a lot. I think 50,000 reduction in the federal employee, in my mind, would be just non-event. There are more jobs out there today on the private sector than there are people willing to fill them. With the unemployment rate so low, I think the private sector could absorb those jobs and nothing flat. And maybe it does good things for the federal deficit. If we don't have those jobs, unless they're essential services, the idea would be eventually we got to figure out at some point, how do we spend less?
Or generate more revenue to pay down.
Right. That means higher taxes.
Yeah.
Or growing economy.
Yeah.
Right. Or cutting government. And the chances are that, all of these things need to be on the table. The problem is it's not very popular.
Yeah.
Right.
Again, no one's talking about it.
Right. So, Bella, do we have the poll questions?
We do. Let me share those here.
All right. So the first one is, what do you think stocks will return in 2024? Looks like consensus is the 5 to 10%.
Average. All right.
And then what do you think will perform best in 2024?
Oh, scroll down. Yeah.
Stocks. Oh.
Stocks.
Yeah, majority said
82%.
stocks. Yeah.
So is this consensus? Should we be nervous? Right. All right. Well, we won't know those answers until 12/31/2024, and we'll stay tuned for those. Any closing remarks, Bella?
I have just a few. Let me share my screen here with some information. Perfect. All right. Well, first, I want to thank our presenters, Carrie, Quentin, and Rachel. Thank you, and thank you for joining us today. You'll be hearing us once this recording is uploaded to our website and YouTube channel, and you'll also should be receiving an email here shortly with a short survey asking for your feedback. We put these webinars on for you, and of course, we want to know what you want to talk about, what you want to hear about. So we greatly appreciate your feedback there.
Well, we had a winner, and then they had put in an anonymous email and phone number, so we couldn't get a hold of them.
Yeah.
But they did win. So
Yes.
if you really do want to win, I recommend putting in the right information so we can call you, because they got a nice gift card to somewhere.
They did.
So we appreciate everybody's feedback. Helps
Yes.
us do better.
Yes. Great reminder, Rachel. And also, if we didn't get to answer your question today, go ahead and email our inbox invest@kwbwealth.com, and we'll make sure to get back to you on that question.
We're always posting content on LinkedIn, on Facebook, mostly on LinkedIn and Instagram, and our website. So please follow us, join our newsletter, and just stay informed. I think that'll help keep you maybe optimistic or at least not aware of what's going on without getting filtered through AI, the information that you were clicking on. Yeah, so we'll try to be unbiased information for you. Yeah.
Perfect. Perfect.
Right.
Well,
Thanks
for joining
everybody.
us.